Today, we're going to talk about Bitcoin, the beauty of mathematics. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Let's go ahead and jump in. So, as of February 1st, 2024, I guess really February 2nd now, the total cryptocurrency market cap is 1.651 trillion, with the fair value coming in at approximately 2.318 trillion. This represents an undervaluation of 28.75%. Now, the way this works is the blue line that you see on the chart is the total market cap of the entire cryptocurrency asset class. And the fundamental idea is that as a function of time, the fair value of the asset class goes up through adoption, whatever, so all the hand wavy stuff, right? But that's the idea, is that as time goes on, the fair value goes up. Also because the Fed prints a lot of money, and when people, when a lot of money is printed, that money will seek to, search out a home for some form of yield. And of course, some of those dollars will inevitably make their way to the cryptocurrency asset class. And so if you fit all of this data to a logarithmic regression function, you get this red line that sort of goes through the middle of the data. And the idea is that there's periods of overvaluation and periods of undervaluation. And you can't really necessarily make sense of it in terms of rationalizing why it should be worth several thousand% above the fair value or 60% below the fair value, other than to just say that's how markets work, right? We go from extreme fear to extreme greed, and we go back and forth. And so sometimes when, there's just pure euphoria, it feels like the markets will never go down again. That's when they top out. And when there's pure fear and it feels like the markets will never go up again, that's when they bottom out. And there's an ebb and flow, though, to crypto, right? Where you have overvaluation periods and undervaluation periods. The undervaluation periods, though, can last for years, right? They can last for years before you go back into overvaluation territory. And in fact, if you look back at 2015, we first reached undervaluation territory in about January. We did not go back to being overvalued until April of 2017. That is 28 months later, 27 months later, 27, 28 months later. It depends on where you take it from, if you say January or maybe in December. But 27 months later, we went back to being overvalued. Now look at this cycle. A lot of people have, compared this current cycle with the 2015, 2016 cycle, and they do look similar in a lot of regards. So we can talk about that. But you can see that we first got undervalued here in June of 2022. Now, 27 months after June of 2022 would put you in September of 2024? If you think about it, September of 2024, that's a long time, right, to be undervalued. But that's how long it took over here. And over here in the last cycle, we actually went into a period of overvaluation for a while, pretty early on. But inevitably, we ended up getting all the way back down and actually tagging this trend line down here. You might say, Ben, doesn't really look like we tagged the trend line. But we did. If you include daily wicks, and maybe I should just go in and include these sort of those lows just so you can see where they actually went to. Like this low over here, came down and tagged this green trend line. Just so I'm not making it up, right? I mean, look at the lower band here. There's a little ticker there, lower band, 103 billion in mid-March of 2020, even though the total market cap here shows it bottoming out at 140, 150 billion. Well, if you go look at total market cap, if you go look at total market cap in March 2020, right down here, you can see that it went to about 108 billion. And you go back over here and you look and you see 103 billion 103, 104 billion is right where that lower band was. So we did go down and tag it. And then after we tagged it, then we went up and we ultimately went into overvaluation territory. But you can also see that, we got above it in 2019 during the QT and the higher interest rates. Now interest rates are a lot higher now than they were back then. We also tried to get above it here in February 2020, and then we obviously had the pandemic. We kept tagging it for a while, and we finally got above it at the very end of the halving year. So last cycle, we durably got above it, the end of the halving year. The cycle before that, it took until April of the post-halving year. So if we were to follow this cycle, the last cycle, it would take until the end of this year. If we follow the cycle before that, it would take until early next year to get back to, to get back to overvaluation territory. If you follow the cycle before that, it took until early of the post-halving year, right? So like February 2013. So there's sort of a range here between, let's call it Q4 of the halving year all the way out to Q1, Q2 of the post-halving year. And again, it could take that long this time to get back to overvaluation territory. And if it did, it wouldn't be out of the ordinary, right? I'm not suggesting we can't go overvalued first. It's possible that we do, but I'm just saying that, like, if it doesn't happen for another year, that would still be well within the realm of prior cycles, right? And it wouldn't be like, it wouldn't be that surprising. Now, what you can do is you can take the percent difference between the market cap and the fair value, and if you do that, you get a chart that looks like this, and you can see that we're still just sort of hanging out at pretty low valuations. And if you look at it, you compare it to last cycle, you can see that we went more undervalued than we are today, than we have been in this cycle. If you go look at the cycle before that, we were more undervalued than we are today. But there's a secret, there's a secret to this stuff, and that is that you could go more undervalued than we've already seen, but it still be a higher total market cap than what we saw. Because look at this, like, we were more undervalued here in October 2023 than we had been at any point previously. The reason was because the fair value, it is a monotonically increasing function, right? So for instance, if you were to draw a horizontal line sort of looking at the prior lows across the screen here, you can see that, it actually takes you out to, maybe Q1, Q2 of this year, right? So you could theoretically go back down. I mean, again, I'm not saying we have to, right? But I'm saying you could theoretically go back down to those lows and still be within the channel, right? I mean, we did that in March of 2020, right? We went back down to the lows and we were still within the channel. And we did it in Q3 of 2015 and we were still within the channel. And you can see here, the lower bound on this total market cap in August of 2015 was about 3 billion. And if we go take a look at where it actually was in March of 2015, August of 2015, we went down to 2.92 billion, right, on that wick. So you can see that in both prior cycles, that happened at some point, and it wasn't out of the ordinary for it to happen. So I just wanted to go back and show this and talk about it. And again, one of the things that we've mentioned many times is what you'll often see happen in this phase, right, in this phase down here, before we get back to QE, what you'll see is that rotation of capital away from some of the higher risk stuff. And I'm not saying that stuff can't go up. If Bitcoin goes up a lot, it can drag a lot of stuff with it. But you'll see that capital rotation from higher risk stuff to lower risk stuff. And then the higher risk stuff tends to pump a lot more when you go back into a QE phase of the cycle, where you go into overvaluation territory in a durable manner that lasts more than just, say, like a few months, right? So, and I said throughout all of last year, all of 2023, I said we're likely going to be below the red line and above the lower green regression line, right? And we were, right? We were between those lines the entire year. And, I'm not as confident this year that we'll spend the entire year between those two lines, but I will say there's a good chance we spend a decent part of the year between these two lines. between the lower band and the upper band. The lower band is all the way down at, the high 700 billion, and then the fair value is at about 2.3 billion. So that the fair value is actually still a bit higher than where we are today. So to get you to 2.3 billion, that is, from the current price, 2.3 billion is, or sorry, 2.3 trillion. 2.3 trillion is about a 44% move above where we currently are. Okay, that would be what the fair value would be. But again, last couple of cycles, we didn't durably reach that level and stay above it until late halving year or early part of the post-halving year. And if you look at sort of market cycle ROI from the peak, and you go look at sort of just the last couple of cycles compared to the one we're currently in, we're actually ahead of schedule. And actually, there was at one point last cycle where we were above the other, this trend line here. And so I almost wonder if something similar is happening, right? Where you go into a lot of people have talked about a translated cycle, right? So you could get something like that again, where you get sort of like an early local top, you cool off for a while, and then we end up debating for 6 to 12 months if we're going to get another top. Something like that could happen, just like that happened over here, right? Something like that could happen again, and you can see we're actually above the last two cycles. And so at some point, I would expect us to have some form of mean reversion back down to to where these other lines are. It could mean we cool off for a few months. It could mean we go down into it. It could just mean that the rise isn't as much, but a lot of different ways that you could get there. But I do think that at some point that will happen, just like it happened over here, right? Last cycle we did eventually get that drop, and it got us below the cycle before. And I think that'll happen at some point, right? Like at some point I imagine we'll go below these two trend lines. And look, it wasn't a popular view last cycle. It's probably not going to be a popular view this cycle, but the point is that from one cycle to another, at least historically, we do experience diminishing returns, whether we like it or not, right? Again, we could always argue whether this time is different, and maybe it is, but I think it makes sense to go into the cycles assuming diminishing returns happens, and then you just be pleasantly surprised if it doesn't. But at this point, we are certainly ahead of where we were the prior two cycles. You could also measure it from the lows, sort of from the bear market year lows, and measure it out that way. And let's just look at these three cycles here. And if you measure it like that, you can see we're actually right in between the last couple of cycles. So interesting way to look at the market. I thought, why not go through this? It's I try to do it on the first of the month or so. Sometimes it ends up being a little bit later, but the reason we do these is because, it's easy to get lost in the weeds, right? It's easy to miss the forest for the trees and to focus on every bit of news. And you buy based on this news, you sell based on that news. But in reality, it's better just to have a long-term plan. You stick to it, and you're just patient, right? For full disclosure, my strategy has just been, and this should be no surprise, has just been to keep my crypto portfolio Bitcoin heavy, because my interpretation of the market was that the Bitcoin dominance would go up, and it has. But congratulations to people who have held altcoins that did well. Not trying to, hold anything against that. There's always some that do well. And even if you held an altcoin that bled to Bitcoin, you took a risk. Maybe it didn't pay off, but maybe it will next time. I don't know. But the point is I think it's worthwhile that you have a strategy, you stick to it, and that's that, right? Where things become difficult is, if you YOLO in at any given point, and if the market drops the following week, are you going to be the person that is going to capitulate, right? So you want to make sure that you have a plan. Like you don't want to go into it not knowing what you're going to do under certain circumstances. That's the way I would say is the best way to navigate the market. And we'll always talk about the risks to the downside. We'll talk about the risks to the upside. We'll try to keep ourselves in check with what are likely outcomes. But remember, at the end of the day, you just have to come up with a strategy, stick to it, and then you can roll your eyes at me anytime I mention Bitcoin dominance. But that's basically what I want to talk about in this video. Hopefully this has been a good sort of 30,000 foot view. Again, we're still about undervalued by about 28, 29%. But my expectation is that we could stay undervalued for a while. there is the halving coming up, so it's possible that you sort of test that trend line going into the halving if there's no major macro events between now and then, but we'll have to wait and see if that's going to happen. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up.